Are you tired of chasing the next hot stock and getting burned in the process? What if I told you there's a smarter, proven way to build long-term wealth without the hype? Welcome to the world of value investing, the timeless strategy used by legends like Warren Buffett to turn disciplined decisions into massive returns. In this video, we'll uncover what value investing really is, how to spot undervalued companies, and the exact principles that separate successful investors from gamblers. If you're ready to take control of your financial future with confidence and clarity, you're in the right place. What is value investing and why it works? Value investing is the art of buying stocks for less than their intrinsic, true value. Think of it as shopping for stocks the way you shop for deals, looking for items worth $100 being sold for $60. The goal is to identify solid businesses that the market has temporarily mispriced and then profit when their prices eventually rise to reflect their real worth. This strategy works because markets are not always rational. Stock prices often swing based on emotion, media hype, speculation, or short-term news cycles. Panic, greed, and herd mentality can cause even high-quality companies to become undervalued. That's where the value investor sees opportunity, not in the noise of the market, but in the underlying fundamentals of the business. A value investor focuses on a company's earnings, cash flow, assets, and long-term potential, rather than short-term stock movements. They practice patience and discipline, waiting for the market to recognize the true value of what they already see. As Warren Buffett famously said, "Price is what you pay, value is what you get." Value investing works because it's grounded in reality, not hype. The core principles of value investing. To succeed as a value investor, you must embrace a mindset rooted in discipline, patience, and rational analysis. Here are the key pillars every value investor must understand. Margin of safety. This is the foundational principle of value investing. It means buying a stock only when it is significantly below its estimated intrinsic value. This gap, or margin, acts as a cushion against errors in judgment or unexpected market downturns. Just as a builder adds extra strength to a bridge to handle more weight than expected, investors should build a buffer into their investment decisions. It's about minimizing risk while maximizing potential return. Long-term perspective. True value investing requires a mindset shift, from quick gains to lasting wealth. It's not about reacting to daily price swings or quarterly earnings reports, but about thinking in 5, 10, or even 20-year horizons. Businesses take time to grow, and their full potential is often only revealed with patience. By thinking long-term, investors can ignore temporary noise and stay focused on the bigger picture. Fundamentals. First, value investors analyze a company's fundamentals before even looking at the stock price. This includes financial metrics like revenue, net income, debt levels, return on equity, and free cash flow. It also involves qualitative factors such as business model, competitive advantage, and management quality. If the business isn't sound, no discount is worth the risk. Emotional discipline. Markets are driven by fear and greed, and mastering your emotions is key to outperforming over time. When markets panic and prices plummet, value investors see opportunity. When markets are euphoric and prices skyrocket without reason, value investors become cautious. How to determine a stock's intrinsic value. Determining a stock's intrinsic value is at the heart of value investing. It involves calculating what a company is truly worth based on its underlying financial performance, not just what the market says it's worth today. If a company's stock is trading for less than its intrinsic value, it may represent a good investment opportunity. Earnings per share indicates how much profit is allocated to each outstanding share of stock. Price-to-earnings ratio compares a company's current share price to its per-share earnings, helpful in gauging whether the stock is overpriced or undervalued. Debt-to-equity ratio shows how much of the company is financed by debt versus owner equity. A lower ratio generally indicates less risk. Free cash flow measures how much cash a company generates after capital expenditures, used to pay dividends, buy back stock, or reinvest in growth. Return on equity reflects how effectively a company uses shareholders' equity to generate profits. Real-world examples of value. Investing in action. One of the best ways to understand the power of value investing is to study how it has worked for some of the greatest investors of all time. These real-world examples show that spotting value before the rest of the market does can lead to tremendous long-term rewards. Apple Inc. In 2016, many investors viewed Apple as a slowing tech company overly reliant on iPhone sales. Buffett, however, saw a cash-rich, high-margin business with strong brand loyalty and recurring revenue streams from services. He recognized the company's intrinsic value and began accumulating shares. Today, Apple is one of Berkshire's largest and most profitable investments, demonstrating how value investing can embrace technology when the price is right. Avoiding value traps and common mistakes. Not every stock that appears cheap is truly undervalued. One of the biggest risks in value investing is falling into a value trap, buying a stock that looks like a bargain but continues to decline due to underlying weaknesses. Recognizing these traps early can protect your capital and improve your decision-making. Don't overestimate turnarounds. Turnaround stories can be tempting, but not every struggling company is capable of bouncing back. Look for real evidence of operational improvements and leadership changes, not just promises. Avoid high debt. Excessive debt can destroy shareholder value, especially during economic downturns or rising interest rates. Companies with weak balance sheets are more vulnerable to default, bankruptcy, or dilution through new financing. Stay updated. Even strong businesses can lose their edge. Regularly review your holdings to ensure the company's fundamentals haven't changed. Industry shifts, new competition, or poor strategic decisions can erode long-term value. Tools and resources to get started. To succeed as a value investor, having the right tools and resources is essential. These can help you research companies, screen for investment opportunities, and make well-informed decisions. Websites. Start with trusted financial sites like Yahoo Finance, Seeking Alpha, and Morningstar. These platforms provide key financial data, analyst opinions, historical performance, and valuation ratios, all of which are critical for evaluating a company's fundamentals. Books. Knowledge is your best investment. Read classics like The Intelligent Investor by Benjamin Graham, which lays the foundation of value investing, and Common Stocks and Uncommon Profits by Philip Fisher, which emphasizes qualitative analysis. Stock screeners. Use screeners to narrow down stocks that meet your value criteria. Look for filters such as low price-to-earnings ratios, high return on equity, ROE, consistent free cash flow, and low debt-to-equity ratios. Value investing isn't about timing the market, it's about understanding it. By focusing on a company's fundamentals, maintaining emotional discipline, and using smart tools to assess intrinsic value, you're not just investing, you're building wealth the smart way. If you found value in this video and want more content on long-term investing, stock analysis, and building financial freedom, don't forget to hit that subscribe button, give this video a thumbs up, and share it with a fellow investor.